What's up, traders? It's your boy Vincent Mukotedi, aka Vin Boss, and I'm here to kickstart the new year. First of all, let me start by saying Happy New Year to all traders. Now, as we all know that we do not trade much in December, so with that being said, we took a little time off, and next week it's about to be the first week where we exercise the skill and see where the markets put us so that we can for sure manifest our skill is still intact and then start trading coming from or going into next week. So with that being said, beautiful traders, let me just start off by saying before today, I'm not giving you trading signals today. Instead, what I am doing today is I'm giving you a strategy to start or to kickstart your year with, which is called the 200 moving average strategy. And this strategy can help you identify bullish momentum, bearish momentum, and neutral markets. Now, I have prepared a simple PDF, and in that PDF is a lesson and the strategy or the details of the strategy, and I have divided them into four simple columns that we'd have to dive into and understand whilst I'm out here teaching you about this lesson. So without wasting further time, let's go straight to our lesson and see what I have in store for you guys this year. Now, traders, before we get into this what we are going to is reading and then understanding. There are some graphical images here to show you exactly what I'm talking about, but at the end of this first part, which is the reading and understanding of what the moving averages are or the 200 moving average is, then we will go to the market itself and test to see how the moving average affect price, or how the moving average gives us perfect signals, buying signals, selling signals, and a caution when the market is neutral. Now, without wasting further time, let's get into this. Now, the first bulletin that we do have is what is moving average. Now, you can answer a moving average by saying it is a technical indicator that smooths price by data calculating the average price over a specific number of periods. Right? I hope it is understood. Furthermore, its primary purpose is to filter out the market noise, making the underlying trend easier to identify. Just like I said in the beginning of this video, that it will help you identify the trend, whether it's bullish or bearish, or whether it is neutral. Instead of reacting to every price fluctuation, a moving average provides a dynamic reference line that adjusts as price data comes in. Trader, Traders use it to, number one, they identify trend direction, whether it is bullish or bearish. Number two, they measure the momentum of the trend. Number three, they determine a dynamic support and resistance, meaning the 200 moving average can act either as support or resistance to the market. And lastly, they avoid trading against dominant market structures. It will help you avoid trading against dominant market structures. By that, what do they mean? They mean that, I'm sorry that I have not been reading out with my highlighter, but I have it now. This is avoiding trading against market dominant structures, and with that being said, determine the dynamic support and resistance. This is exactly what I am reading. And measure the momentum, identify trend direction. This is why traders use the moving average form. And I'm not only talking about retail traders, I'm talking about institutional traders. Now, let's go deeper and into this so that we can go directly. I'm trying to move faster so that it doesn't take too much time. Let's go into this and understand in simple terms. Price is reaction, the moving average is structure. So price react on structure, price respect the structure, price is defined by structure, and structure by this is moving average. But not every moving average. We are talking about the 200 moving average, not the 50, not the 20, not the 25, not even the 100 or 150. We are specifically talking about the 200 moving average. Now, with that being said, let's go and understand the different types of moving averages that we are going to use into these strategies, and how what individually they are and how we can use them to identify or to solidify trading signals. Different types of moving averages. This is bulletin number 2. Different types of moving averages. First of all, not all moving averages calculate price the same way. The difference lies in how much weight is given to recent price action, which is the move. Do you see here? I did mention if you want this PDF, you can just comment that you want the PDF and it will be sent to you directly. Now, I did mention that all moving averages will be set to 200 moving averages. I hope that makes sense. Now, the first moving average that we are going to deal with, if you don't know the moving average, this is this blue line that is moving across the charts. Now, simple moving average, SMA, for if it's the first time you're hearing about the moving average, then you will never forget simple moving average, especially if you are a Nasty C fan. You already know that SMA is a good, beautiful song by Nasty C, so you just have to remember it by Nasty C. Let's just call it Nasty C. So this Nasty C simple moving average, I know it sounds funny, but it's my way of trying to make you guys remember how this works, or what this represent in the market. So with that being said, I did mention that it is the blue line, and it calculates the average price evenly across all period. It calculates the average price evenly across all periods. Every candle has equal importance. It is number one, what I want you to pay attention to. It is slower to react to sudden price changes. It is very slow to react to sudden price changes. We are talking about spikes, we are talking about, you know, strong momentum or change of structure that happens fast. It is slower to react to that. There are other moving averages going deeper into this lesson that are faster to react to those kind of price movement, which is why I wanted you to make sure that all of this moving average, you get them together to give you a defined trading strategy. Now, this one is best for identifying long-term trend direction. the simple moving average, which is the blue line right here on this picture that is depicted here, it is best for identifying long-term trend direction. Now, here it says this is a visual representation of the simple moving average and how price reacts to it. Now, number one, what you can see is as soon as it crossed to the upside, it acted as support. And remember, I did mention that over here, we did mention that it acts as support. Here I did mention that this moving average acts as support and resistance. So right now we are going to show you how it acts as support and resistance, right? And it helps you avoid trade against dominant market structures. So let's go back to where we were, which is right here. This acted as support. After this break of structure to the upside, pullback came, acted as support. A pullback came, acted as support, and continuation to the upside. The change of structure came, pullback came, acted as resistance now, and a continuation to the downside. This is a 200 simple moving average, right? Now, for those of you who still don't get it, let me do a small understanding of this. Now, when price, when the price, when the moving average is below the price and candles, it is below just like this. The price and the candles are on top of this blue moving average. The trading signal is a buy, which means you would have bought here and here. When the moving average is above price and candles, the trading signal is a sell. Just like as soon as it went down here, the moving average was above the price and the candles. This remained a sell. I hope that makes sense. Now, this, what I just taught you, is the simple moving average. I want us to go straight and directly to the exponential moving average. And with the exponential moving average, what we are going to deal with, which is B, the second moving average that we are going to deal with, is the exponential moving average, which is the orange line. If you look closer here, there is still that blue line, which was the simple moving average. Now it has added exponential moving average. Now let's dive into this exponential moving average and get to understand the difference between the exponential moving average and the simple moving average. Now, the exponential moving average gives more weight to recent prices. That means the old prices don't matter as much to this. That's why it is a bit faster to react to the market. Reacts faster to market changes than the simple moving average, which was said that it reacts slower to recent price changes or to faster price changes, right? More sensitive during volatile conditions. The simple moving average is still slow even during volatile conditions, but this one is more sensitive to it. Preferred by traders who want earlier trend signals. This one can tell you trend signals, and even these moving averages, they talk too. They give certain signal too. Now, since the blue line, which is the SMA or the simple moving average, is slower, and the exponential, which is the orange line, moves on top of, like, moves faster, this simply means that if it is a buy, the moving average, the exponential, is going to move on top of the simple moving average, and it's going to remain on top of the simple moving average unless trend changes and we go to the downside, and then the exponential moving average again is still going to go below the simple moving average because it is faster to react to sudden price movements. I hope that makes sense. As you can see, it is still acting as resistance to here and here. It is still acting as support here, here, and here, just like the simple moving average. Now, the key points here is it responds quicker but can produce more false signals in, check this, in ranging markets, which means when the markets have no clear direction, this one, the exponential moving average, because it adapts faster to spikes and volatile markets, it can give you false signals. Hence, using it alone is not credible enough. You need to mix it with the 4 moving averages that we are going to deal with into this lesson. Remember, we are still going to go to the video where we start everything else. Maybe we will back test for a month or even 2 months and then see how price reacts to the moving average so that you can use it for your own good and let it help you make money. Now, with that being said, this will tell you how price changes fast, but you better be careful in ranging markets. But it also gives you faster reactions to the market changes, right? So it is preferred by traders who want earlier trend signals rather than late trend signals. When exponential moving average crosses above the simple moving average, the signal becomes more reliable and clear. I hope that makes sense. This is exactly what I tried to show, and they are crossing here, is crossing above, and they are crossing here. The moving up, the exponential moving average is crossing below the SMA. So it simply means their crosses mean something you should pay attention to. Now, without wasting again much of our time, we are going to the smooth moving average. Now, with the smooth with the smooth moving average, or SMMA, which is the red line in here, we have introduced now the red line. And the red line, listen to what they're saying. A red line is a hybrid between simple moving average and exponential moving average. It reduces volatility even more than the simple moving average. It reacts slower but produces cleaner trend visual. It is slower, but it gives you a clean trend visual. What I want you to pay attention to with this smooth moving average, which is the red line, here we sort of went below the exponential moving average and the simple moving average before we came back up and continued to the upside. But the bounce was so perfect on the smooth moving average because it was slow and it gives clear trend visualization. Commonly used in trend following system. If you're following a trend, this is best for you to use, which is the SMMA, which is the smoothed moving average, right? Best use when you want clarity over speed in the market. This is the tip for it. You are using it when you want clarity over the speed market. When the simple moving average crosses below or above the smooth moving average, the signal also becomes clear. This emphasizes validity of the signal shown by the moving averages. This lesson must be in your head. You must understand it. You must see it. You must live it. You must breathe it so that you can see the market much better. Now, traders, I have given you this. This is number 3. This is number 3 of the moving averages. We have the blue one, which is the simple moving average. We have the red one, which is the smooth, the moving average, and we have the orange one, which is the exponential moving average. Now let's go to the last but not least moving average before we have a conclusion and we go straight to the back testing and we do it live right here with you guys. Last but not least, which is the linear weighted moving average, or the LWMA, which is the green line. We are going to explain deeper into it with our lesson today. This is the linear moving average, LWMA. This is the green line, and as you can see, there's a green line there, right? Now let's see the key elements or the key factors for us to understand the linear weighted moving average. Now, they say assigns the highest weight to the most recent candle, not the price, but the candle. Older candles progressively matter less. Older candles, they don't matter. What matters is the recent price. Faster than simple moving average and smooth moving average. Useful for detecting short-term momentum shift. I want you to pay attention to this. Useful for detecting short-term momentum shift. By this point, everything should be clear about the moving average signals and how to treat each of them to profit better in the markets, right? It is faster. That's why when it crosses on top, it stays on higher than the exponential moving average, the simple moving average, and the smooth moving average. When it goes low, it goes lower than the exponential, the simple moving average, and the smooth moving average. Now, this is what we are dealing with, and as you can see how they react to price. We are going to go to the market just now, but before, let's just see the advantages of using the moving averages, right? The 200 moving averages. Remember, you can put 15 moving average there. It does not work the same principle as the 200 moving average. So with that being said, let's go straight to reading what this has in store for us. The advantages. Using 4 different moving average calculations, all set at 200, offer a multidimensional view of trend strength. Now, the key advantage is trend confirmation. When all 4 200 moving averages align, the trend is strong and validated. When they diverge, the market is lacking clarity. Momentum quality. This one was trend confirmation. This is momentum quality. Fast moving averages crossing slow moving ones indicate acceleration in the market. Flat alignment signal signals consolidation or neutrality, right? And then we have the dynamic support and resistance, which is exactly what we have just shown you, how they both act as support and resistance to the market price. Now, price reacts to the moving averages, cluster increases probability. Strong reactions indicate institutional participation, right? False signal reduction. When you use all four, remember, one moving average can lie, four agreeing moving averages do not lie. I hope that makes sense to some traders. Now, last but not least, this approach shift trading from prediction to confirmation. Using four of these moving averages that we just learned about, it reduces prediction, but it emphasizes confirmation. Now, we have to go to the rules of trading these moving averages themselves. And traders, these are the moving averages rules, or the rules of the moving averages. These are the core principles you should emphasize before going to the charts. Now, with that being said, the rule number one, moving average acts as support and resistance. In an uptrend, price respects the moving average as support. And in a downtrend, price rejects the moving average as resistance. The 200 moving average is the most respected level of the moving averages. We are not talking about the 50 moving average. We are not talking about the 25 moving average or even the 100 moving average. We are only talking about the 200 moving average. And with that being said, let's go to my visual representation of the moving average acting as support for buy signals in the market. Now, first of all, the market was below the moving averages. It was clear from this time, and then the markets moved above, and as soon as they moved above, the market came back to retest the 200 moving average, especially where they crossed over to align to the buying side. And after they've crossed over, this became a buying momentum. Change of structure, higher low, and then the structure is to the upside, a retest of this as support, continuation to the upside, higher low, new high, and a retest again of these moving averages and a continuation again, and so forth and so forth. Now, price respects the 200 moving average, whether we are accepting this or we do not want to accept this. The 200 moving average makes the world go round because of one thing: price respects it as support and gives clear buy signals. I hope this makes perfect sense to traders out there. Now, we are going to the moving average that is acting as resistance, right? Moving average acting as resistance for sell signals. Now, after the crossover below, this was a retest, came down, retest, came down, retest, came down, retest, and came down again. This signifies or symbolizes resistance in the market, the rejection of price trying to go to the higher side or above the moving averages and continue down. But if you were using some 20 or 50, it would have been around here, making it difficult for you to allow this retest, and that signifies what? The strength of moving averages, which is pretty simple if you look at it. Now, traders, rule number 2 is moving average define bullish momentum, right? Price consistently above the 200 moving average equals the bullish momentum. Higher highs plus moving average support equals continuation bias. If the market keeps on making higher highs and the price keeps on reacting as support to the moving average, this equals higher highs. This equals a continuation bias. Pullbacks into the moving pullbacks into the moving average offer high probability entries that match us with the bias that we do have. Now, with that being said, traders, let's get into this. Now, below here is an example of price above moving average, pull back into the moving average, and a buy signal. Price above the moving average, pull back, a retest acting as support, and this is the signal to go and buy this continuation to the upside. And below is the result of the signal after the pullback. This is what we are talking about. After the price has retested, this came about like this. Because there was an uptrend, it moved to the upside, a pullback to retest the support as the moving average, and a continuation to the upside. Doing this regularly removes guessing from the markets, and it gives you confirmation. Now, I hope everybody sees this. We are going to the video to make sure that this video ends in a beautiful and easy to understand and easy to see manner. Now, traders, without wasting time, let's move over to rule number 3. Rule number 3 states or indicates that moving average identify neutral markets. Moving averages identify neutral markets. Now, how do they identify? Price chopping around the moving average. Price, this is, let's say this is your moving average, and then price is just chopping around. This is time for you to get out of the market because there's no clear signal in the market. This is what it means. Flat moving average equals low momentum. This is why I made a straight moving average. They are flat. The best condition to stay out, not trade. All right. Now, below is a perfect example of how moving averages tell us when the market is not safe. With that being said, let's go and see what the market tells us when it's not safe. Now, this is, look at this. New low, new high, new low, new high, and all the moving averages are just in a linear form. Low, highs, no direct lows, can come back again, and then do a high. Do you see this? This is when the moving average is telling you do not trade, stay out, relax, look for a continuation and wait for a pullback so that we can retest again. Now, this is what the moving average helps us with in the market. Now, without wasting further time, before we go to the charts, first and foremost, I want to Make sure that everybody understand that Vinboss Signal Factory are not selling magic indicators. We are teaching market structure awareness. Moving average do not predict, they do not guarantee entries, they align you with probabilities. Now, with that being said, let's go and see how the probabilities play in real time and in real market conditions. So, traders, this is the pound and the dollar chart, and I've just pulled this up so that we can just emphasize how the moving averages work. Now, without wasting much of our time, one thing is for sure, we are trading a very volatile market, which is the pound and the dollar. So we chose to start last year in November because I didn't want this video to be longer than it already is. So without wasting much of our time, let's get into this. Now, every single time we have a selling momentum, remember, this does not necessarily mean we cannot get any losses. No. Also, this includes trading psychology within it, right? Now, let's see what this has in store for us, given the fact that this is the first week of, wait, I was busy talking and I didn't realize, or I didn't act on what I was trying to tell you, so I let this replay run. Now, if you are, for that matter, here selling because there is a bearish engulfing, and this candle has a tail and followed by a bearish engulfing, of course entry will be here and stop loss will be here. Not only because of that, but because we have moving average acting as resistance. And why do I sell this? Because we are in a downtrend. The moving averages are still above the price and candles. So maybe your 1:5 is all right for the week. This is 1:5. I know someone would say, no, man, we could have gotten like 1:10. That's fine. But greed is not what I endorse. I don't want people to be greedy in the markets. It only ends in pain. So you would be done for the week in just a couple of hours. This is a 30 minutes time frame, of course. And with that being said, this is how it would have been, maybe 1:5, and then that's it. You are done for the week. Let the week unfold, or wait for another signal confirmation from this level and then a continuation to the downside. If you're not content, 1:5 in one day, that's good enough. And then you're going to go again, wait for the confirmation. As long as there's no moving average being rested or no bearish patterns confirming that the test is real. Oops. You see, engulfing to the upside, no selling pressure at all. And even right now, okay, from this level, this is where we will be starting to look for bearish opportunities. Now, if you do get this, and do 1:5, you are blessed enough if it goes in your direction. We do not want to talk about the ethics of break even in here. Here we are. Oops. Here we are. This means you would be stopped out. That means your profit ratio is 4 now. It's 1:4. You have 4 of what you are risking in the market. And look at what we are having again. Bearish patterns on top of the moving average before the break continuation is confirmed. You will sell, of course, and then after this invalidation, this means you might be entering again to see if we are going to the downside or not. Oh, the week is over. Have you seen? The week has been over. You have 1:3 in profit only if you traded too many times in 1 week. But if you traded once, it's 1:5, and then you wait for the coming week. Now let's see what the coming week has in store for us. Change of structure to the downside. Confirmation, of course, and then we are going to go to the downside because there is no validity that goes to the upside. Here we are again. This is the change of, firstly, this is the change of structure that I was talking about. And then you find selling opportunities from this level to continue to the downside. Let's see how they play out, of course. One is to 5 in the beginning of the week. From here, change of structure, you're trying to go to the bottom of it, but you can go into is to 10 if you are that confident, but you would have won before this. And there is no changing of structure to the upside. You can still re-enter somewhere here because there is no break to this level, of course, and it is still going down to the downside, right? This is 1:5 in a week. Now in 2 weeks now, if you only trade 1:5, you have 1:10. No losses from the first signal that you had from this week, and you let everything play the way it is supposed to play. Remember, traders, that we are still going to look for market movements that favor or that do favor choppy. Look at this. Okay, pause. You would not trade if you are paying close attention that the moving averages are converging and they are forming a straight line. You will not trade in this. After winning this 1:5, you are done for the week and you will wait for another week. But one thing is for sure, if you are a price action trader, you are only looking at what the market is trying to tell you. Structure to the upside again, structure to the upside here, retest, structure again to the upside. Now let's see what it does in the end. The week is over. What you'll be looking for is buying opportunities going into next week. With carefulness. You have to, number one, let me just write while the market is moving. I hope I don't miss any opportunities. You have to wait for a break to the upside, a pullback into the moving average confirmation, bullish patterns and formations, and then a continuation to the upside. This is what it will look like. You are waiting for this. So as long as the moving average is still straight like this, there's nothing happening in the market. You can go play football, play chess with your friend, just keep on watching and wait for the breakout. Is this the breakout that you're looking for? Maybe. But since this bigger correction to the upside looks like a two wave to the upside, we might be going back up from this level to retest maybe this level, or if it reaches above here, it simply means that the market is going to the upside with no shame. And remember, this week, oh, I was busy talking and trying to remind you again. One thing that you have to pay attention to is, but you wouldn't trade this. Trust me, you don't have to trade this. So at the end of the week, what you would have is, because this is a momentum to the downside, this is where your 5 would be. 1:5. Why sell from this level? Of course, selling from that level indicates that there's bearish momentum, pullback, entry level, continuation to the downside. And we just hit that 1:5 risk to reward ratio right here. You are good again for this week. Now, just imagine or just predict how every week you will make 1:5, 1:5, 1:5. Does that make sense? Using the 200 moving averages. Now, let's continue with this. This is Friday. Now, what do we expect from this Friday is a continuation to the upside to break out the structure so that we can come and retest the moving average. That is option number 1. Or a break of structure, pull back, look for bearish opportunities, and then excuse me, a continuation to the downside to take out 1:5 in our desired strategy rules. Now let's go into this. No change of structure, of course, yet. No clear change of structure here. Wait. This means that we are here at the liquidity and we are still rising above this level that I mentioned, which is 1.31547. This level here, if we are rising above it, it simply shows the buying momentum, and we have to zoom out again. Remember, the market is not only charts like this. You have to zoom out and see the overall structure and what the market is trying to tell you. Now, what I think the market is trying to tell us is, after this two wave to the downside, we had A, B, and a C, and then now we are continuing to the upside. But since we in this strategy, it is only focused on the moving average, we will only, and I do mean only, be focusing on the moving average entries, support and resistance levels, so that we can try to make money out of this. So with that being said, good people, let's go straight again to the understanding of what is happening in the market. Now, this is a strong momentum to the upside, clear bullish momentum. You're waiting for your moving average retest and then boom to the upside again. Here we are, we did test, continuation to the upside is there. Voila. The retest is here. Let me pause first. Break to the upside, retest, boom. This is how it works. Break to the downside, retest of the moving averages as resistance, boom, 1:5. Retest of break to the upside, retest of the moving averages as support, boom, to the upside. 1:5 can be measured there. Now, once everything else clicks with this strategy, what you can see is there is limitation of losses and everything. Even if you missed this trade, let's just pretend as if you missed this trade, there will be another chance coming. Guys, I'm gonna have to speed this up. I don't want this video to be more than 2 hours. Clearly this is not my intention to take for this video to take this long, so I would like for this video to be as short as possible. So what I'm doing is speeding this process up. And retest of these moving averages, of course we are going to look for buying opportunities to the upside, another retest of this smooth, and then going to the top. Of course it's gonna go to the top. This strategy works like a charm. This strategy works like a charm. If there's a retest, you take it to the upside. If we go below the moving average, we know that something has changed. Still gonna look for buying opportunities, of course, because the moving average says we are to the upside of this. Everything the moving averages say to us, we are looking for buying opportunities in that matter. Another retest, continuation to the upside. This is what the moving average signals look like. Now I'm trying to speed the process up so that you can see what it's like in real markets when you are using the 200 moving average to your advantage. Look at this again. To the upside, break to the downside, to the upside again. This looks like a change of structure. Retest to the upside. The markets are contracting. The moving averages look like they are about to be straight in a linear one. To the upside, the retest still acted as support. To the upside, everything supports the moving average. Let me just pause here. I wish I could, but I'm trying to avoid this video being long video. So this was a retest, but it looked like a break to the downside. So if you were looking for selling opportunities from this, you would have realized that this is a strength to the upside, and buying momentum started on Monday, continuation to the upside. This is how this works. Everything else is continuation to the upside if it retests the moving average as buying opportunities, and everything else follows after that. Okay, break to the downside, the retest, break to the downside, retest again, retest again. This looked like we were going to make, this is the second, oh, this was on Friday. Yes, and this is how the week ended, right? The 2nd of January was on Friday, and this is how it looked. Now, if you follow this moving average, do you realize, I wished I could have shown you how much money you would have made with this buying momentum to the upside. So that is it from me, traders. I hope this strategy, you can come back to this video as many times as you want to see this strategy, to master the strategy, and as always, make sure that you follow the rules to the peep and to the dot and to the last of your breath. So with that being said, thank you for watching this video. Thanks for subscribing to this channel. If you are not already in the channel, make sure you like and you subscribe. This is gonna change your life again and again and again. The more you watch it, the more you realize. And remember, if you want the PDF before this video of the chart analysis, if you want that PDF, please comment PDF on this video and you will get the PDF right away. So with that being said, Thanks and happy trading. Enjoy everything that you are doing in this world this week, and next week we are going to be out there in the markets trying to understand what is happening, and then the week that follows after, we are making money again. Next week I'm just testing my skills because I've long been away from my computer, and now I'm back on it, baby. See you during the week.